There are many ways to build massive wealth in the stock market. I've read over 100 books on the topic. I'm not sure if that's a humble brag or a cry for help, but regardless, I have a deep understanding of this stuff and I'm excited to share the details. There are two portfolio strategies that have stood above the rest over the past many decades, and these are none other than the Warren Buffett 2-fund portfolio that he recommends to the masses, and the Boglehead 3-fund portfolio that has maximum diversification. In this video, we'll dive deep into the details of both, and we'll also cover the simple factor investing strategy that I have used to outperform both of these core portfolios for each of the last 10 years. And make no mistake, my portfolio is based around these two behemoths. I think anyone that veers too far off the simple path is destined to fail. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please submit that like button, subscribe if you haven't already, and drop me a comment down below with your idea for the best portfolio mix. We have 10 new channel members this week. I want to give a huge shout out to the 10 names on the screen and, of course, all of you that have been here along the way. I hope you're enjoying the spreadsheets and the perks that come with the membership, and I got to do a little better job of selling it here, so maybe I'll show some more examples in the future. But for now, I just want to say thank you very much for all of your support. You are making this possible for me. If anyone out there is interested in joining, the link is in the description below. You'll get access to a lot of the nerdy spreadsheets you see on my videos and a few other ones. Emotes, badges, and priority in getting back to comments, because it's tough to keep up with them all sometimes. Let's grow. Bogle and Buffett. Jack Bogle and Warren Buffett are my two biggest role models in the investing world. Bogle was the one that popularized lazy investing via index funds. He was a smart man and he was full of common sense. He tried tirelessly for decades to find a reliable way to beat the market. Eventually, he decided to create the first index mutual fund to replicate the market. This was the ultimate if you can't beat them, join them move. Warren Buffett, on the other hand, is a completely different type of investor. He's one of the very few that have been able to outperform the market for multiple decades. And he hasn't just outperformed the market. He has obliterated it. His total returns over the past 40 years are about 50,800% to the S&P's 4,200%. And yes, those are real stats. You can go look it up if you want. It seems unbelievable. I'm with you on that one. And Mr. Buffett thinks that 99% of us should invest in a simple 2-fund portfolio. I listen when someone like him gives free advice. The best portfolios. Warren Buffett often recommends investing in this simple 2-fund portfolio. 90% of the funds should go to a low-cost S&P 500 fund, and the other 10% are in short-term government bonds. I use a money market for this. And his money is where his mouth is. This is exactly what he has in his will for his wife when he passes away someday. Jack Bogle, on the other hand, and his followers, the Bogleheads, believed in total diversification. And I mean that very literally. The Boglehead 3-fund portfolio will invest in the total US stock market, that is every single company in the United States, via something like VTI, the total international stock market, and you can use VXUS for that one, and the total US bond market. You can use BND. Those 3 funds have well over 20,000 holdings. They quite literally hold everything in the world, basically, with zero overlap. I slightly prefer the S&P 500 to the total US market, so I like VU slightly better than VTI, but we're really splitting hairs. When we zoom out, the returns have been nearly identical over multiple decades. About 85% of the total US stock market, or VTI, is made up of the S&P 500. The other 15% of the total US stock market is about 3,000 small and mid-sized companies. All right, now we're gonna get a little creative. We're gonna mesh these portfolios together. I think I found a mix to satisfy both of these legends. The Buffett heads. 45% VU for Mr. Buffett, 45% VT, and now VT is 60% VTI, which is the total US stock market, and 40% VXUS, which is the total international stock market. And then 10% in short-term government bonds or high yield savings or a money market. Basically your cash equivalents. I like VMFXX, the money market. This setup will beat well over 90% of actively managed funds over any 20-year stretch of time. In the next section, we're going to discuss why that is. VU and VTI are not average. There are a few of you here on this channel that constantly ask the question of why settle for average with a fund like VU or VTI that just basically pulls in the entire market. The truth is that the S&P 500 actually outperforms just over 98% of actively managed funds over 20-year stretches of time. I learned that statistic and a lot of others from the book that Jack Bogle wrote called The Little Book of Common Sense Investing. It is still by far and away the best book I've ever read on the topic. But if you're anything like me, you think, no way, that is absolutely made up. It's not true. Well, it's true. I've tried to debunk it, trust me. In fact, just for fun, as I was scripting this video, just real-time spur of the moment, I opened up Seeking Alpha and I created a new ETF screener. And I just pulled in all US ETFs, basically, like pretty much wide open criteria. There were 3,305 ETFs that were pulled into the screener, and VU was ranked 67th on total return over the last 10 years. And keep in mind, this includes all the incredible passively managed ETFs that follow technology index and growth and stuff. That was the majority that beat VU. I kind of looked through the list. I didn't count them up officially, but there were very few actively managed ETFs that outperformed VU in the last 10 years. Now, this is something I've extensively researched, and I'm happy to report that it is not random. Think about it like this. VU is an ETF that's made up of the 500 largest companies in the United States, which is 85% of our overall market. It's mathematically impossible for VU to mistime a market rotation. You always hear about how dangerous timing the market is, and it is. There's a lot of crazy stats out there, but VU eliminates all of that. VU doesn't have to worry about when to buy and sell NVIDIA, for example. VU holders got the entire come up of NVIDIA by its proportional weight relative to the 500 companies. And guess what? We don't even have to worry about when to sell NVIDIA. It'll just hold it. And when it levels off or goes down a touch, and we have new up and comers, VU's automatically grabbing everything in proportion. VU naturally has a nice mix between growth stocks and value stocks because it just pulls them all in. And lately, of course, it's been a little heavier in, technology and growth stocks because those are the ones that have put the most money in our pocket. But value stocks have the more impressive long-term history, and they will make a comeback. The reversion to the mean will happen, and when it does, VU will be gathering all the gains as that event unfolds. We would likely be best off to just roll with these indices and chill, but that would be boring. So let's talk about why I break the rules in the next section. How I built my portfolio. I started with Buffett's 2-fund portfolio as my base case. I take the same approach as Bogle regarding international exposure. Like Buffett, he was a huge proponent of the US stock market. Now, the Bogleheads have ultimately added a mostly agreed upon about 20% international to the 3-fund portfolio. And I don't think that that's a bad idea at all. I'm constantly watching the ETF VXUS to stay up to date on things, and I'll likely be a little too late to the party, but I won't miss it altogether. All right, the fun stuff. I think that I can outperform the S&P 500 long term. Now listen, I do not plan on hand-picking my winning stocks. I know that that is a loser's game. I have been able to outperform the market every single year by using simple logic. I have a 30-30-30-10 mix. Now 40% is Mr. Buffett's recipe. It's 30% VU and it's 10% cash equivalents, money market for me. I aim for 30% growth stocks and 30% value stocks in the remaining 60% of the portfolio. This is because the S&P 500, the competition, has been a nice mix of growth and value stocks over many decades. I like SCHD for my value play and VGT for my growth. Now, I'll admit it, and I've said it a million times on the channel, I am a major tech bull, And that's not handpicking, for example, right now, the best AI stocks, but I just believe in tech as a sector. It always seems to be the next big thing over the past 40 years or so. But I do think that QQQM, the NASDAQ 100 index, is a better set it and forget it forever growth ETF. And that does it, that's it. I don't get too cute with any of the advanced factor investing because the more we tinker with things, the more we lose. It's just how it works. I feel that the value stocks within SCHD are on average better than the value stocks of the market. And then same thing with QQQM. I feel like those select growth stocks are better as a whole, as a bucket, than the growth stocks within the market. And I do get a lot of comments, like, why not just go all growth, all VGT or QQQM? I'm stunting my returns by leaving SCHD in my portfolio. Or on the flip side, wait till tech crashes. You're just a lucky performance chaser. You better load up on more SCHD type things or go to the Boglehead portfolio because your performance chasing is going to run to a brick wall. I'm not going 100% value just because it's been better the last 100 years. And I'm also not going 100% growth stocks for the newer investors, to jump on their bandwagon just because it's outperformed value by 7 or 8% over the last decade. My goal is to outperform the market in every situation, so balance is key. Anything that I peel away from the core portfolio recommendations of like either the Boglehead or Buffett's will be balanced in a vacuum. So if you look at the things I choose to buy that deviate, when you add them together, you'll have a similar mix of growth and value. I'm a large cap guy. I know small cap performs better sometimes, but it has higher ceiling, lower floor. So I won't be perfectly balanced there, but in general, you'll notice that things will stay imbalanced at an overall level. All right, let's stop talking about it and let's see the results. Total 10-year comparison. We're going to be comparing my mix to the Buffethead Hybrid 2.5 fund portfolio. We're also going to throw in Berk.B to show that, first of all, I am not Warren Buffett, and if I led Berkshire, it would lead to disastrous results. But I'm also going to show some trend lines versus the market for an additional reason of why I don't handpick stocks without thinking about overall balance like Mr. Buffett does. Let's go. We're out on Portfolio Visualizer, my favorite site on the internet to do portfolio backtests. So for this one, we'll be looking from 2012 through 2024. This is actually roughly my investing journey, and we can't go back further than 2012 because of the age of SCHD. We're putting in an initial amount of $10,000 and contributing $3,050 per month. I know that's a random number, but I'll get into that. I'm trying to mimic my journey to show how these have ultimately compared. Monthly contribution, rebalance annually, reinvest dividends and display income, yes and yes. So I'll show what we have here. We have my mix, which is a third VU, a third SCHD for value. And you'll notice for the growth, I have half and half of QQQ and VGT making up the 1/3. Now I've used VGT historically, and it's actually performed a lot better in this timeline. So this is going to under exaggerate my performance, but recently I decided to add QQQM. It doesn't have the history, so we have to use triple Q here. But so now my new growth is half and half. So we'll just use this one moving forward, even though my actual performance has been a little better with VGT. And then portfolio 2 is the Buffethead. That's Warren Buffett's VU for 50%, and the Boglehead's VT, and that has international and VTI for 50%. And Berk.B is Warren Buffett's fund that he manages, Berkshire. So it's 100% of portfolio 3. Let's get this thing going. My mix, starting at 10,000, ends up at about 1.36 million. This is roughly what my portfolio is at today as of this recording. The Buffethead index fund mix would have been 1,061,000. So it's not shabby, but I've crushed the market over the years. And Berk.B in the last 12 years has also outperformed these index funds by a solid amount. It ends at 1.230. So he runs an amazing fund. You can see here that the best years are within a reasonable range. The worst years, it looks like Buffett outperforms a little bit. The max drawdown's very similar. The Sharpe and Sortino ratio, you want these higher for risk-adjusted returns, and my mix outperforms both. And then the market correlation, this is off the screen because I want you guys to be able to see as much as possible. 0.98 for my mix, 0.99, of course, for the indexes, and 0.73 for Buffett's. We're going to come down to annual returns, and this will show the story that I really want to portray. You can see my mix is the blue bar, the index mix is the red bar, and this orange bar is Berk B. So I want to point out that Berk B is a little more all over the map. Look at 2015, it lost a bunch of money. The year before in 2014, it smashed the markets. And it tends to be a little more all over the map. After that bad year, it bounced back and just destroyed the markets. He's not balanced according to the market. He owns stocks that he finds to be valuable investments long term. He doesn't believe in quote unquote diversification. He has quotes saying things like your first 5 picks are better ideas than your 6th and 7th and 8th, and so on. You can see that puts him all over the map year by year, but he kicks butt long term because he's great. If people like us do stock picking, we're going to have a lot of these down bars because timing the market's difficult. If you look at the blue bar compared to the red bar, the very first year in 2012, it looks like the index beat us, but then 2013 is a win, and it's an up year. 2014 is a win, up year. 2015 is about flat, but we beat the market. 2016, as you can see here, these bars are always close. And now that is comforting to me because I want to beat the market every year. I want to beat the market when it looks like this in 18, when it looks like this in 2022. You can see we beat the market. Now Buffett destroyed us, but we beat that market. But I also want to beat it on the up years. If I'm not close to the market, I'm doing something wrong with my value and growth mix with passively managed ETFs to essentially recreate a focused VU is the way I look at it. So every year we're slightly outperforming the market. And as you saw above, that can add up to $300,000 or more over time. Now, so far in 2024, Buffett's having himself one heck of a year, and we are losing to the market mix thus far. So we'll see what happens. Now, if you look at the trailing returns, you can see, again, the 1 year total return, my mix has outperformed the market in the last year, 22% to 19.5%, and Buffett's right in there. Now, in the last 3 years, you can see Buffett's running away, but we're still 8.1% compared to the market's 5.9. Over the last 5 years annualized, 15.02 compared to 11.3 of the market. Over the last 10 years, the mix is 14.4% to 10.3%. And over the full 12 years and change, we're at 15.6% per year to 12%. Now, 3.6% is hundreds of thousands of dollars, as you may know from messing around with the portfolio projector I have out for the members, or just general tools on the internet for the masses. Like 3.6% will turn into 7 figures over an investing career. So that's a big outperformance right there, even though it seems like it's only 3.5%. Here's the thing. A lot of people will smash the market in a year or two, sometimes even 3, and they'll tell you about these advanced strategies, these sweet factors they found with whether it's market cap or momentum-based things and, growth and value leaning hard one way. I want sustainable victories. So I don't want any of this to be fluky. When I don't beat the market, I should be close to beating the market. I never want that disastrous fall from trying to get too creative. And you can see here, Berkshire doesn't pay a dividend, as most people know, but the dividends will grow. Actually, I'm kind of impressed with the market, but you will outpace the market. As you can see here, some separation over time. I'm sitting on about 21,000 of passive income compared to 17,000 per year at this point. The point of this video is to explain how you do not need to know exactly what you're doing to invest like the 1%. Just buy low-cost, passively managed ETFs that track the market, and you will dominate this game. And the major key to investing, regardless of what portfolio mix you go with, is to never panic sell when the market is crashing and everyone else is running. Keep on dollar cost averaging in, especially during that time. Consistently put in as much money as you're able to afford over many decades, and you'll get to where you want to be. Check out this video right here if you want to find out how to build a solid dividend-based retirement portfolio with $1 million or less. Or check out this video if you want to see a year-by-year example of how to actually live on that portfolio in retirement. Thank you for watching, and I will see you here next Sunday. Peace.